Here's a number that might surprise you. More than 70% of Canadian retirees say their biggest financial worry isn't the stock market, it's taxes. And I get it. Let's say you've saved up $1 million in your RSP over your career. That looks amazing on paper, but the moment you retire and start drawing that money out, that $1 million might only be worth $650,000 or $700,000 once the CRA takes its cut. That's because RRSP withdrawals are fully taxable. CPP and OAS, also taxable. Your other investments, likely taxable. And if you're not planning how you withdraw your money, not just how you saved it, you could end up losing a huge portion of your retirement income to taxes. And here's what most Canadians miss. Tax planning doesn't stop when you retire. In fact, it's just getting started. So in this video, I'm going to walk you through 3 simple but powerful strategies to help you reduce your taxes in retirement. They're easy to overlook, but if you use them right, they could save you thousands every year. Hi, I'm Darcy Bell, certified financial planner professional with IG Wealth Management. I help Canadians grow, protect, and optimize their wealth, especially during retirement. And if you've ever wondered how to get more out of your retirement income and less going to the CRA, you're in the right place. Before we dive in, make sure to like this video, leave a comment if taxes in retirement are something you're thinking about, and hit subscribe so you don't miss any future insights on retirement and tax planning in Canada. Let's get into it. Here are 3 smart tax strategies that most Canadians miss in retirement, but that could make a big difference for you. Strategy number 1, get tax diversified, not just investment diversified. You've probably heard the phrase, don't put all your eggs in one basket. And when it comes to investing, most Canadians get this right. They diversify across stocks, bonds, sectors, maybe even real estate. But here's what gets overlooked. Tax diversification is just as important, especially in retirement. Let me explain. Most Canadians save the bulk of their money in RRSPs or company pensions. And while those are great during your working years, there's a catch. Every dollar you withdraw from a tax-deferred account, like an RRSP or a RRIF, is fully taxable. You lose flexibility. And when those withdrawals bump up your income, they can also affect your OAS, your GIS, even your taxes on investment income. So what's the solution? You want to have money in 3 different tax buckets. 1, tax deferred, like your RRSPs and your RRIFs. 2, taxable, like non-registered investment accounts or GICs. 3, tax-free, like your TFSA. Here's why this matters. Let's say you need $60,000 a year in retirement. If you pull it all from your RRIF, that full $60,000 gets taxed as income. But if you pull $30,000 from your RRIF, $20,000 from your TFSA, which is tax-free, and $10,000 from a non-registered account using capital gains, only 50% taxable, you've just created a much more tax-efficient income stream without sacrificing your spending. That's the power of tax diversification. Gives you more control, more flexibility, and often less tax. And that leads us right into the second strategy, because once you have those tax buckets, the next step is knowing when to use them. Strategy number 3, harvest capital gains the smart way. If you have money in a non-registered investment account, this is one you don't want to miss. Most people think capital gains are something to avoid in retirement because they add to your taxable income. But what if I told you there are years in retirement where you could realize a capital gain and pay 0 tax on it? Here's how. Let's say you have $150,000 invested in a non-registered account. Maybe it's in a stock or an ETF that's grown in value over time. Let's say it grew by $50,000. If you sell it, that $50,000 is considered a capital gain, but only half of that is taxable. So now you've added $25,000 to your taxable income for the year. But here's the key. If your overall income is low enough, let's say in those early retirement years we talked about, you might still be in a very low tax bracket. And in Canada, some capital gains may be taxed at effectively very low rates if they don't push you into a higher bracket. So instead of avoiding capital gains, you can actually harvest them strategically and either spend the money, reinvest it in a new security, or simply increase your adjusted cost base so you pay less tax later. This is called tax gain harvesting, and it's especially useful when you're between jobs or semi-retired. You've delayed CPP or OAS, or you've already built up RRIF and TFSA income streams and are looking for ways to manage taxable income. It's not just about minimizing tax today, it's about reducing future tax bills by locking in gains when your income is low. Think of it as using your low tax years to your advantage, but it does take planning, because if you accidentally trigger too much income, you can bump into a higher tax bracket or lose OAS benefits. That's where having a financial planner who can model out your income, taxes, and investments year by year makes a real difference. So now we've covered 3 powerful strategies. 1, tax diversification. 2, smart RRSP withdrawals in low-income years. 3, capital gain harvesting when the timing's right. But how do you put this all together? What you should do next, so you've seen 3 strategies that most Canadians miss when it comes to reducing taxes in retirement. Spreading your savings across multiple tax buckets, using early retirement years to smooth out your RSP withdrawals, and harvesting capital gains while your income is low. Each one of these strategies on its own can help, but when you combine them into a smart, coordinated plan, that's when the magic happens. Because retirement isn't just about having enough money, it's about making that money last longer, stretch further, and support the life you've worked hard to build. If you want help building a personalized retirement income plan that keeps your tax bill low and your lifestyle protected, click the link in the description to book a free, no obligation consultation with me. We'll look at your retirement accounts, your income sources, and how to use these strategies based on your actual numbers, not just theory. And if you found this video helpful, give it a like to let me know. Share it with someone who's thinking about retirement, and hit subscribe so you don't miss future strategies on retirement and tax planning in Canada. Thanks so much for watching, and I'll see you in the next one.